Good Thursday morning. How we doing out there? My mic is on. Where is the activity? Hello, hello.
Doing good.
All right, Amber. Thank you so much. So much. How about some cameras on? Let's see some smiling faces. Kate's got her camera on, and then it kind of Chris has got some sort of an angle going. I don't know if she wants her camera on, but it's on, Chris. Oh my God, you guys. Well, Katie Sheehan, welcome back. We missed you last week. How are you?
I'm good. Thank you for having me back. I missed you guys last week.
I think you were out because of a mess on a closing, if I remember correctly.
Yep, we had a messy closing that needed some attention right then.
Do we want to just start by talking about that, or
Sure.
yeah, let's do that.
So pretty much it was, I mean, so this was, past the point where we're looking at offers and everything. We're at the closing table now. So we are, right up at closing. We had the docs that came over from the lender. And I guess the moral of this story is when you are looking for your commitment and the lender sends the initial CD to your client, they're all e-signed. So when you're waiting for those to come over, people get excited and they think, cool, we're done. Please make sure that you remind your client to actually review the CD when it comes over, because this particular CD came over and it had collecting escrows for everything. It also needed flood insurance. So she was escrowing for flood insurance, homeowners insurance, and for her taxes. And taxes were required. Homeowners insurance is, up in the air if they'll allow you to pay it out of pocket. That's up to the lender. But flood insurance is required to be an escrow. And all three were on there, but she wanted them all removed. And so because she didn't look at her CD when it first came over 3 days prior, as TRID is, truth in lending, supposed to be giving you that information up front, she didn't review it. She just clicked and signed. So then when I sent her all of her documents the day before, we're supposed to be closing at 9 a.m. on Thursday. Sent her all of her documents on Wednesday for review, and she comes back at like 7 a.m. on Thursday morning. I'm not coming in to sign. These docs are wrong from the lender. We're not supposed to have escrows on there. I refuse. I'm not doing it. And I was like, well, everything you've signed so far has had escrows included. She never told anyone she didn't want those escrows on there. She just decided it and I guess assumed it would not show up because she didn't want it without communicating that information. So, unfortunately, at that point, what had happened is the lender had already funded us. They had already sent us their wire. So now everything is locked. Once the lender sends their wire, they can't make any changes. So the only way we could get any adjustments made is to send the wire back to them. Once they have their money back, now they'll change the docs and they will resend the wire for the correct amount. So in this instance, the only thing that they could remove from the escrows was going to be the homeowner's insurance. And so we were able to, okay, we'll send the wire back, we'll get it going. They removed the homeowner's insurance. They didn't tell us until after we had sent the wire at 8:30 in the morning on Thursday that it can take them up to 72 hours to acknowledge receipt of that wire. So now we're looking at a rate lock issue. We are looking at a clear to close issue because we're contracted to close on Thursday and everybody's wanting to get out. They want, people want to move in on the weekend. People want to, get their funds to buy their own homes, and we're just stuck. We now have no money from the lender. We can't even sign the incorrect docs and fix it later. And now we have to wait up to 72 hours for them to even acknowledge that maybe we got their wire back. So turned into a fiasco. We had to reach out and try to get an extension from the seller side. They refused. So officially, with their refusal, we're now out of contract. And if this doesn't close, she's going to lose her deposit. So we ended up being able to just kind of push it off, and we got it done the next day. So we were able to get them to acknowledge receipt of the wire on Friday morning, and then we got documents, and we didn't get to record until Monday, but we got at least the corrected documents. They acknowledged the wire. We got our wire funds back. And then we signed late in the day on Friday, didn't get to record, went to record on Monday, but we released under GAAP, which means seller got their money, so people were able to move and do what they needed to do. But that was a Thursday morning fall apart that I was not expecting, especially when it involves sending wires into the ether and you don't know when they're going to arrive or return.
Yeah, there's so many little nuggets in here. The first one I want to start with, though, is you used a term called released. What did you say? Released with gap?
Yep.
Okay, so I've never heard that term. Let's talk through what that term means. This is, I'm assuming, something along the lines of, "Hey, we got the money, you just couldn't get on record," but clearly everybody understands this was a closing that happened, and the property has transferred hands.
Yep, that is exactly what it is. So Connecticut is kind of a gap state, the way that they work. So if you do any deals in Connecticut, it's really similar to the way Connecticut operates. Connecticut just says as soon as we get our money, it doesn't matter if we're on record or not, you're good to go. You can go ahead in the property, you can access. So since COVID, it's been what's called a gap affidavit, and we include it in all of our seller docs. And the gap affidavit says essentially, but for recording, everything is done. For all intents and purposes, we are closed. We will release the seller funds. We will grant the buyer access. Everyone is aware that there are no more changes. The walkthrough is complete. They can't move in. They can't fund under gap, get into the property, and then say, actually, you know what? I kind of, I want you to come back and fix this door. It's done. Everything is done and finalized for all intents and purposes. And we just record first thing in the morning. So we always try to have, and it's not something that we try to use all the time because it is not the standard. It's not what we want to do. We want to be on record. We want on record, then the property and people can get in. Because it's up to the sellers if they want to allow the release under gap. Sometimes people say, no, I want to see that recorded deed in the registry and I want that done before anyone accesses the property. I don't care if it means I don't get my money until we're on record. And if that's the case, we have to respect that. Um, Generally, though, if they sign the gap affidavit and we just didn't get to record, especially, on a Friday or a Thursday when we're getting up on the weekend and we don't think we're going to get to record, or if the party has moving trucks outside of the house, we'll get that document signed and then we can release the funds under gap. So we release the seller proceeds. And like I say, very similar to Connecticut, once those proceeds are received, they can go ahead and get into the property if they need to.
So the affidavit is only needed in states like Massachusetts, where it's not standard to basically have a release without recording.
Exactly. So
Right. Okay.
Connecticut is a state where they do the release as soon as the funds are received by the seller. You can go right ahead and access the property. So that's their natural state. That's standard practice for them. Massachusetts is not. Massachusetts is you can't access until we're on record. If the parties agree to this gap affidavit and they sign it, then we can release the funds. And as soon as that's done, then they can access the property. So it's kind of, I keep it in my back pocket. Obviously, we try not to have closings on Friday afternoons, is what we don't like to see. We
Yep.
try to avoid closings on Fridays entirely, just especially in the summer, because the registries are busy and you might not get to record. We could close at 9 a.m. and you still might not get to record if we need funding authorization or something like that. So it's something we try to keep in our back pocket, make sure we get the sellers to sign it, and then if need be, we have it, but we still need to get authorization from all parties.
And then the other thing that you kind of mentioned there is acknowledging receipt of the wire. So um, the wire, obviously, by your bank, I'm assuming happens fairly immediately. And it's just this is
Yep.
a larger bank, so they weren't in a position where they could just call somebody up and be like, "Hey, did the wire come through?" Or they were being difficult. Just kind of talk me through that.
Yep. So on our end, as soon as we release the funds, the way a wire works is you release your funds on your end, and then you get a confirmation of an outgoing wire. So we have that confirmation, and then once there's a Fed ref number, a Fed reference number, that is the official like money transfer. The government is saying like, hey, I'm acknowledging. FDIC is saying I acknowledge that this money is in the ether and it's being sent. So it can take, we usually say, it can take up to 24 hours for a wire to hit, but generally speaking, you're going to see it in 2 or 3 hours. It's usually pretty quick. We were dealing with sending money back to a large mortgage company, and the way it was just one of those things where the groups don't speak to each other. The originators do not talk to the funding department, don't talk to this. It's a cog in a machine, and to try to like back that machine up and bring it backwards, no, and everyone's like, I don't know who to talk to. Like, we acknowledge them within 72 hours, and I'm like, that doesn't help me in this situation. I need you to call someone and find out if the money has arrived. But that was the problem. So wires are generally very quick, but we had a closing yesterday where the buyer wired their funds first thing in the morning. They sent two separate wires from two separate banks for as the closing cost that they needed to send. We got the wire from the mainstream bank that they had. We did not get the wire from the credit union that sent it. And oftentimes with a smaller bank like a credit union, if they're sending a wire, they only have one time. Like, they send wires out at 3:30 in the afternoon once a day. They collect them all during the day, send them all out at once, and that's it. And if that's the case, you really want to make sure that your clients know if they're wiring funds, that they know what the timeline looks like for the bank that they're wiring funds from, because that one didn't get to record either because we weren't funded. We didn't get their funds in time. And it was we got them, they came in at like 5:30 in the evening, but it doesn't help anybody when, these particular folks did not sign gap and were not interested in funding under gap. So once we were funded, we still had to wait to be on record, which won't happen until today. So wires, while in general immediate, and we try to say, they can take up to 24 hours. Always, if your clients are going to be wiring their deposit, if they're going to be wiring their cash to close, make sure they have checked with their bank and they know if the bank is going to hold wires until the afternoon and send them out all at once, or if they send it immediate, or sometimes other banks, like if you have the bank that's not brick and mortar, a lot of the companies that are online, if you set up a wire, it can take them 24 to 48 hours to send the wire because they want to take it, review it, accept it, then send it. So always have your clients, if they're using a bank or they're sending a wire transfer, make sure that they know what their bank's timing looks like, because they might not be able to wire at the closing table and have us be funded same day.
Anybody have any questions around the wiring process or anything regarding maybe the CD? I've actually never run into, client gets the CD and signs, and then there's an issue later. I've never seen that, so that's a new one for me. Anybody have anything around this? Anybody have something happen on one of their transactions? Hey, on mine, this happened with the CD or anything like that, that would be just a good share or something to watch out for?
This was actually really common back, I'm going to age myself here, back before 2015, before TRID really came into play, because people wouldn't have any idea what was on their CD until closing. Once we got the documents from the lender, we'd send it out, but that could be the day before closing, and that's the first time that they see their final CD. At least now with TRID, they are required to give these 3 days notice that they have, they send it out within 3 days of the closing. The goal there is for the party to review it and to understand what's going on. And so it obviously happens. This client just assumed that they were sending her more e-sign docs and she just point and click, didn't even look it over. And we really need to make sure, I remind my clients, I don't know, a lot of you know because you've been working with me, I'm doing coverage for 2 attorneys this week. So this was, one of the attorneys is on maternity leave. So this was actually her file. I wasn't familiar with this client. I always send out to my clients like, hey, this is what's going on. Make sure that when you get your CD, check it over, but it's not final because we still need to get seller adjustments. You're looking at bank final numbers. That would have been perfectly helpful for her to realize that the escrows were off and that it needed to be corrected and adjusted, but she didn't look at that. But also, when these numbers come in, people think they're final and they go out and get their checks for that amount. And it's not correct because the lender doesn't have the seller adjustments. They don't know what the final water reading is or the oil adjustment. So those 3 days are for us to make those seller adjustments so that the numbers come out correct. And then we can issue that final amount for closing that the buyer needs to bring.
In this particular case, Kate, do you think part of the issue was like the number was so large of what she was having to bring to the table that she wanted, hey, can I not put that in escrow or not put this in escrow to just save me some money? Or was there some other thing that we should be thinking about, what buyers might be thinking about putting funds into escrow?
So in this particular instance, this was a tough one. Like I say, it was an inherited file. She was not my client to begin with. She had a father who was in finance, and she was, a teacher, first-time home buyer. She was using a program, which is the Teacher Next Door program, which is a company. One of the loan officers through Loan Envy issues that out, and so they get a discount and they get some good rates on it. The the issue with this one, I think, really was that she was listening to her dad, who was in finance, who's saying, like, don't wrap anything into the mortgage that you don't need, because if you wrap it into your mortgage, it's going to count towards you're just going to accrue interest that you don't need to accrue because it ups the amount of mortgage that they have to put on in the first place. It raises your amount. And for the initial payment, that's correct, but that's not going to carry over for the entire life of the loan. So I think she was listening to multiple people, and no matter how many times you told her, like, this is not part of your mortgage, these are escrows, it's a separate thing. It's not going into your principal and interest. This is a separate account that's being collected. And she just had it in her mind. This is, she was going to listen to dad, and this is, dad was looking out for her. So I think when it came over in her mind, she was like, I can get a better rate if I do it this way, and I won't be paying interest on it. And no matter how many times we explained, this is not part of your mortgage, the principal and interest is mortgage only. Escrows are separate. Um, she just wanted it gone, and she was not going to sign until it was gone. So it had to be gone.
Let's just pause there for a second. I haven't looked at any in a mortgage in a long time. Is it still more the norm that something besides principal and interest are getting tacked into your monthly payment, or not the norm?
So
Would you
for
say?
escrows, you mean like people
No,
like is it
not
more common for escrows?
no, not necessarily for escrows, but actually what the dad was saying, where your monthly payment is increasing because every month now it's 3,200 instead of 3,000 because something else is tacked in there.
Right. So that no, it's not really the norm.
Okay.
We're not seeing that. It's especially, and in this instance, especially where it was escrow, it's a very separate thing. I think she was mixing up, because there were other things that were in there, like wrapping in her inspection and her appraisal, because she's a first time home buyer. Part of this program is everything is wrapped in, so she's not paying anything out of pocket. It's all wrapped into the loan, which makes it easy. But in that instance, her father was correct. You're adding fees that are going to raise the loan amount. Loan amount needs to cover that amount. And so if you're raising your loan amount so that you can cover your appraisal costs and you can cover, all of these other fees that are in there, that initial mortgage amount is going to be higher and you are going to be paying the interest on that over time because that's the amount that you're paying off. In this particular instance, it wasn't that case. I think she had just heard her dad saying, don't wrap anything into the mortgage, don't wrap it in, don't wrap it in. And no matter how much I explained, like, this is an escrow, this is a separate addition that's taken in monthly, it's not part of the principal and interest. It was not computing for her. She wasn't seeing it, but it's not common to see that now, no.
Any other questions around kind of anything that Kate covered on this one? There's a lot of little twists and turns on that closing. And it's crazy. I mean, there's two or three things in there I've never seen before. I've seen a lot. Can you think of any other issues or things that maybe we should be talking to our clients about regarding the CD? Hey, typically these are the couple of things that when there is an issue, it's going to go in one ear and out the other. If you're like, hey, the CD just came over from the lender, can you just review it, whatever? It
Mhm.
might be beneficial if you said, hey, make sure you look at X and Y, or because I know these things come up as issues, or I don't know. Do you have any thoughts there on where the issues tend to arise on a CD?
I would definitely I mean, I would say the things that you want to have them look at are things that are out of the norm. So if you know that there is a seller credit, have them, make sure that they take a look and see that they have a credit on there. If they're getting a lender credit, make sure that they're looking to see that the lender credit is in there because a lot of times people aren't aware that if you get a seller credit at closing and the bank can't use it, if they can't use the whole thing, the credit is going to be lower. They're going to lower the amount because they can't just give you money back. So that's why, in the beginning, like, you don't want to go with a crazy high seller credit because they may not be able to use all of it. So your client is not getting the benefit of that credit entirely. They're not getting the entire aspect of it. So I would always say look at the credits, make sure that they're aware of what those credits are going to be. And the sooner you ask, are we going to be able to use all of this credit, the better. Because then if we need to adjust or if we need to go back to the sellers and say, hey, listen, my client can't use this entire credit, can we reduce the purchase price? What are some things we can do that we can adjust this for? And a lot of times people don't want to adjust the purchase price because obviously you're looking at adjusting commissions and everything else down the line that follows in with that. But if you're looking at $10,000 or over, I would say sometimes even 7,500 or over, make sure you take a look at that credit and see if it's being eaten up entirely or if there's a portion that's just not being used. That's number one. Always check your escrows if this is a person, we've get our older clients who are like, I am going to pay my taxes myself and I am going to pay my homeowner's insurance myself and no one else is going to tell me otherwise. Sometimes the lender requires it. And if that's the case, then it has to be on there. If they've given a waiver and they're saying, yeah, no problem, make sure that they check at that time when that CD comes over that the escrows are the way they expect so that we're not running into this problem like right at the closing table when it comes up and I review it with them. Those
Let
are
me
the
let me
two biggest
let me
things I
pause
would
you on that
say.
one, Kate. How often are the lenders just? It seems like it's obviously in the lender's best interest to make sure that that stuff gets included in the payment, right? How often
Yeah,
are you seeing lenders that really just don't care? Yeah, you want to pay that separate? That's fine. Is
it's
that
very rare. What I'm seeing a lot of is that the lender will only allow it if you're putting 20% down.
okay?
If you're already at your 80/20 split in your equity and you're not needing mortgage insurance and all of that, then they're like, okay, your credit score is good. You seem like you're not a risk, and I will allow this to go forward. I've seen a lot of lenders who only will do a waiver of escrows if that is the case. Other times, if they've got a solid payment history, like if they're a continuing member of this bank and they're doing like a refinance and, they've been able to show continuous consistent payment with, no late fees, no missed payments or anything like that, and they ask for the escrows to be waived at the time of refinance, the bank will let them do that, but they have to show that history and kind of the rapport with the lender that it's worth it in their end and in their eyes, because escrows are entirely for the benefit of the mortgage company. A lot of people like to say it's like, oh, it's so easy for you because you don't need to worry about paying the taxes. You don't need to worry about paying the homeowner's insurance. All it is it's a protection of the collateral for the lender. That's why they want it. Because a town, if you don't pay your property taxes, a town can foreclose on your property and take it just the same way as a mortgage can. So it's their way of saying like we want to protect our collateral. We want to make sure that it is fully insured for homeowners insurance. We want to make sure that the property taxes are being paid so that there's no chance of foreclosure to the town. And so that is why the lender requires them. So usually you're going to see them on there. Most of the time, if you see that they're being waived, it's not with first-time home buyers. You're seeing it with well-qualified older folks who are coming in, putting down 20%, you know, able to show that they have no issue, making these payments, and they can show a good credit history and all of that, and then the lender may waive it.
I did want to come back to something that you're talking about there, making sure that you can use the entire credit. I want to make sure everybody understands that, right? So if you were able to negotiate into the deal, let's say a $15,000 seller credit, um, those funds have to be used towards something. They can't just get money, right? So it's
Yep.
usually, it can go towards any closing costs, points, prepaids,
Yep.
escrows, I believe, right?
Escrows for the first, yeah, escrows that can be included in the prepaid escrows for the very first CD, but not continuing on.
Right. Right. So if all of those things come to $12,000 and you've got a $15,000 credit, you're only going to get $12,000. That
Yep.
extra three just goes back to the seller. Right.
Yep.
And so that's what you really got to understand. That's what Kate's referring to here when you say make sure you can actually use the 15,000, because they can't just get money back and bring less or something like that. Like they got to use it towards something that's
Right. So
getting
if you
paid
when
at
it's
closing.
written in saying that it's being used for, cost prepaids, all of that, that's all it can be used for. So the lender is not going to say, "Oh, and there's $3,000 extra left over of this credit. We're just going to credit it back to you." It's a credit only. It's not monetary. It's like credit in the ether. It's not a tangible fungible money thing that they're going to be able to give it back to the buyer if they don't use the entire credit. So that's why I always, when you're getting into real high credits, and if it's repair credits and there's work to be done and you can put it towards, it's listed as being put towards the repairs and work, that's one thing. But we also try not to do repairs on the purchase and sale and do a credit for those repairs because we don't want the lender thinking, what's wrong with this house? Now I need to reinspect and I need to go back out. So it's a very fine line. The higher the seller credit gets, the more hairy it becomes.
Any other questions on this scenario? The other thing that I heard in there, Kate, and it definitely makes me nervous, is all the e-signing that's going on.
Yep.
Um, so, just a kind of high alert for agents when purchase and sales are being done, and those are going out for signature. You really should be just not passing that along, right? You were part of those negotiations. You maybe were even having a conversation with your client about why we're doing certain things. And I think a lot of times the client doesn't even understand exactly what you negotiated for them. And so they don't even necessarily know what to look for. So, it's always been, yes, I think the attorney should review the purchase and sale contract with their client, but the attorney also wasn't there during negotiations, right? So please make sure you are reading your contracts and, whatever that is included in the purchase and sale, right? Hey, in the MLS, they didn't list the, whatever washer dryer, but we negotiated that in. Make sure that got into the purchase and sale. Don't
Right.
just pass this stuff along and your client's signing off and nobody reviewed it and the client doesn't remember to look in the purchase and sale to see if the washer and dryer is in there, right? So please, make sure you read it and look for the key things that were part of that negotiation.
Yes. When I draft the purchase and sale or when I review a purchase and sale that's sent to me on when I'm on the buy side, I'm bound by the black and white written into the offer. That's all I can this is what's been agreed to, and I don't know any of the extra outside conversation that's happened. So when that's drafted up, I'm going by what's written in the offer, but if you've negotiated after the fact, the washer and dryer is a perfect example that that's going to remain. If it's not in the offer, I don't know about it. And so any of those secondary things that are coming up, it's always a good idea just, be the fresh set of eyes, because you have the on the ground, your boots on the ground. You know what they want, you know what was agreed to. I can only go by the written offer. So if you know that there's something different, you can always let me know and I can bring it up. Hey, I was told that the washer and dryer, can we include that? Everybody checks with their client. Yep, we're good. And we add it in. But if it's not written in there, I really need your second set of eyes reviewing it to make sure that anything outside of that offer that was decided on is in there as well.
A couple of other things along this line, Kate, and I don't know if this is part of your practice. I personally think it should be part of every attorney's practice. But when you're getting a contract, is let's say for some reason you as the agent didn't have a really, are you sure you have another place to go? We've run into this a couple of times where, client mentioned something about finding suitable housing, and yeah, I kind of got something, and we do a purchase and sale, and nothing's in there about suitable housing. And then we're getting to the closing, and the seller's going, well, wait a second, I don't have a place to go. We're going to have to extend this. And we've got nothing in the contract that talks at all about this. So I don't know if there are a few things, Kate, that you have on the checklist that just says, hey, regardless of what the purchase and sale says, I'm going to ask these couple of things, because if this didn't get covered, this is really going to put my client behind the eight ball. So I don't know if you have any of that stuff, but
So if we're on the seller side, definitely, like when we're, because purchase and sale comes out, and it on the buyer side, I'm really relying that the other side, they have their own attorney. I'm relying, if I'm on the buy side, I'm relying that the sellers are speaking to their attorney and their agents, and that they know what they're contracting for here. On my side, if it's a seller side, as soon as I see anything in there that says, closing in, at the same time as their new purchase, I'm always, you've got to be aware. You've got to make sure that you may not get in. If we're doing domino closings, you've got to set your expectations correctly, because not everybody will allow you to fund under gap. And if there's a problem with that first closing and we don't get to record and they're not going to let you fund under gap, you're not getting into your next house either. And so sometimes if you're trying to do those domino deals where it lines up, where it's multiple in a day, and you can have it where I have one right now where the buyers of, so we have a sale and the sellers are selling their home and at the same day they're buying. But the people who are buying the seller's home, they need to sell their home in order to have the funds to buy this. So we're lining up dominoes, and the last one or two are very likely not going to make it on record same day. That's just the way it is. We do our best to make it happen, but there's just on the timing of it, there's not enough time in the day to get all of those funds transferred to make sure that everyone gets to record in a timely manner. And if that's the case, you need to make sure that expectations are set. If we're doing a domino closing, there will be a time where you are homeless, between where your sale goes through and that the new buyer has now purchased your home and you're on record, but you have not closed on your second home yet. So now we haven't purchased the home yet. You've got this time in between where there is no place for you to go. And if this doesn't close, if your purchase doesn't close, you're going to need to find a place to go, because they're not going to let you in if they don't fund under gap, or they're not going to give you a use and occupancy. And that's their right not to. You're not entitled to the home just because the funds didn't come through. So always remembering to set expectations. If we're doing multiple closings in a day and they're lining up, you want to make sure that they understand there is going to be a time where there's nowhere for them to go, and it may not, if it doesn't go forward, they need to have a plan in place if they're going to do a hotel or whatever the case may be.
anybody have any questions, comments, concerns regarding those domino closings, or have something happen weird on one of yours that would be a good share? Well, normally I close by saying, man, you guys were just so interactive, and the back and
We
forth
were
today was
riveting
great.
today, Steve. We
Apparently
kept them
it
riveting.
was just you and I today. Nope, nobody wanted to speak up and add to the banter. I don't know. Maybe nobody found this one too exciting. Lauren, I see you're
You guys were just
unmiked.
so good.
Oh, it was so good. That's what it is.
We had nothing we could even top either of you with.
There's no notes. No notes.
Uh, Well, I hope you guys did enjoy at least. I enjoyed it for sure, Kate. Always love chatting real estate with you. Go crush your Thursdays. We will wrap up the week strong tomorrow and do it one more time. All right? Take care, everybody.
Thanks, everyone.